Good morning. This is Crystal Biting, Vice President, Investor Relations and Financial Planning and Analysis for the SJM Smucker Company. Thank you for listening to our prepared remarks on our fiscal 2025 second quarter earnings. After this brief introduction, Mark Smucker, Chair of the Board, President, and Chief Executive Officer, will give an overview of the quarter's results and an update on strategic initiatives. Tucker Marshall, Chief Financial Officer, will then provide a detailed analysis of the financial results and our updated fiscal 2025 outlook. Later this morning, we will hold a separate live question and answer webcast. During today's discussion, we will make forward-looking statements that reflect our current expectations about future plans and performance. These statements rely on assumptions and estimates, and actual results may differ materially due to risks and uncertainties. Additionally, please note we will refer to non-GAAP financial measures management uses to evaluate performance internally. I encourage you to read the full disclosure concerning forward-looking statements and details on our non-GAAP financial measures in this morning's press release. Today's press release, a supplementary slide deck summarizing the quarterly results, management's prepared remarks, and the Q&A webcast can all be accessed on our investor relations website at jmsmucker.com. We invite all interested parties to join us at 9:00 a.m. Eastern Standard Time today for a live question and answer session with management to further discuss our second quarter results and outlook for the full 2025 fiscal year. Please contact me if you have any additional questions after today's question and answer session. I will now turn the discussion over to Mark Smucker.
Thank you, Crystal, and good morning, everyone. Our business momentum continued into the second quarter. Building on our positive start to the fiscal year, we delivered results that exceeded our expectations, which allows us to increase our full-year adjusted earnings per share guidance. Our strong comparable net sales and earnings growth were driven by sustained consumer demand for our iconic brands, combined with our continued focus on superior execution and disciplined cost management. While we continue to operate in a dynamic consumer environment, our business remains resilient. And as industry volume growth has remained uncertain, our focused portfolio continues to deliver volume mix growth driven by our key growth platforms. We continue to prioritize resources toward the key platforms which are our largest growth opportunities. Starting with Uncrustables sandwiches, which grew net sales by 16% at the total company level. This growth was driven by our national advertising campaign, distribution gains, and new merchandising investments to drive trial and awareness. These actions delivered a record quarter for both sales and household penetration. To fuel continued growth and meet demand for the Uncrustables brand, we successfully started production at our third plant in McCalla, Alabama. The 900,000 square foot facility is the company's largest Uncrustables sandwiches manufacturing site. This new capacity also enables us to go beyond $1 billion in net sales and to deliver innovation through flavor extensions and seasonal offerings. For example, in September, we launched a peanut butter and raspberry spread Uncrustables sandwich, and results are already exceeding our expectations. Although early, this new offering is quickly becoming a top variety for the Uncrustables brand. We also launched peanut butter-only sandwiches in limited distribution that we will begin to distribute nationally next fiscal year. And our Halloween-themed chocolate-flavored hazelnut spread Uncrustables sandwiches inspired trial and more eating occasions. We look forward to driving more seasonal activations. With this incredible momentum fueling the Uncrustables brand, we now anticipate full-year net sales for the brand to be over $900 million in fiscal 2025, exceeding our initial expectation of $100 million of net sales growth. In pet foods, the Milk-Bone and Meow Mix brands contributed positive volume mix in the quarter. The Milk-Bone brand demonstrated mid-single-digit volume mix growth led by soft and chewy and biscuits. Strong net sales growth in soft and chewy snacks of double digits versus the prior year was aided by innovation, namely Milk-Bone Peanut Buttery Bites made with Jif peanut butter. This launch continues to exceed our expectations, and we are excited to launch this product nationally this coming January. We continue to drive the humanization trend in the category. As one of the few companies with both iconic human and pet food brands, we are able to create a unique consumer experience of consumers sharing foods they love with their pets. In cat food, the Meow Mix brand continued its momentum with high single-digit volume mix growth in the quarter. The Meow Mix brand has the #1 volume share position in the dry cat food category, and we are fueling further growth by refreshing the brand with new packaging launching in January. This new packaging design showcases consumer-desired claims in a fresh, new way with elevated product benefits and a more modern design. We are also launching innovation at the same time that will bring the indulgence and dual texture experience out of the wet aisle and into the convenience of the dry aisle to elevate the mealtime experience for both the cat and pet parent. And in coffee, the Café Bustelo brand was the fastest growing leading brand in the mainstream, one-cup, and instant categories in the latest 13-week period. In the quarter, the Café Bustelo brand grew net sales by 20%, continuing its momentum of double-digit net sales growth. We continue to focus on expanding the Café Bustelo brand nationally and broadening the consumer audience, and we have exciting plans to fuel additional growth, including innovation launching next calendar year. Turning to our final key growth platform, the Hostess brand, we are not satisfied with the current results of the Hostess brand and are taking the necessary actions to return the brand to growth. Net sales continue to be below our expectations, driven by two primary factors. First, consumers continue to be selective in their spending, largely driven by inflationary pressures and diminished discretionary income, causing the sweet baked goods category to recover slower than we have anticipated. These trends are causing a reduction in all channels, inclusive of convenience. Second, we are not performing with excellence from a distribution, merchandising, and competitive standpoint. We have underperformed in the channels where the consumer is shopping, resulting in lost share. With the integration now complete and synergies being realized, we are focusing our plans on ensuring execution in support of growing the Hostess brand. These plans include delivering the base portfolio, expanding distribution, driving innovation, continuing our portfolio evolution, and establishing revenue synergies. Each of these pillars represents a key strategy to grow the Hostess brand. When it comes to driving the base, we're focused on multiple levers. First, we are refocusing on driving displays, which remain a key element of our strategy due to the impulse nature of the snacking category. We have commercialized several new display vehicles and are starting to gain traction in this important tool for driving consumption. Second, we are launching a bold new marketing campaign, leveraging our proven marketing model at Smucker. This campaign will be aimed at building cultural relevance, particularly among millennials and Gen Z, who represent a tremendous opportunity for growth. Third, as part of the brand modernization, we're refreshing the Hostess brand packaging to make it more appealing, accessible, and impactful in stores, which will increase impulse purchases and reinforce the brand's distinctiveness in the marketplace. Each of these initiatives has been accelerated to begin in the first quarter of calendar 2025. Expanding distribution also remains critical, and with the company's advanced capabilities, we're unlocking new channels and opportunities for the Hostess brand products, particularly in away-from-home markets. Our focus on distribution includes both closing gaps of our core items in our existing channels and critically entering new channels, leveraging the company's strong away-from-home sales force. By dedicating a new sales force and exploring optimal packaging formats, we're well positioned to serve the evolving needs of consumers who are increasingly on the go. We will continue to deliver innovative products that resonate with consumers, introducing flavors, formats, and limited-time offerings that keep the Hostess brand exciting and top of mind. As part of our wide range of innovation, we are focused on delivering value to consumers by launching new sharing sizes of our Donuts branded products, and also launching $1 packs of our core donut and cake products that will be sold on display. And we are committed to transforming our portfolio for sustained growth. The recently announced divestiture of the Voortman business underscores our strategy of focusing resources on our largest growth opportunities. Further, we are ensuring our network is fully optimized to unlock costs, reduce complexity, and drive quality. And finally, we are beginning to establish revenue synergies, a key fundamental of the acquisition. This includes expanding Uncrustables sandwiches into C-store using our new capabilities of the convenience channel, representing a large white space opportunity for the company. Additionally, we plan to expand cross-promotional events between the Hostess brand and legacy Smucker brands, where early reads are very positive. One example of how we have started to see the potential benefit of cross-promotion is through a recent execution between the Hostess brand with Jif peanut butter and Smucker fruit spreads, which yielded strong results. We will accelerate these cross-brand revenue synergies and are excited about the potential in co-promoting multiple iconic brands, including combining impulse purchases with non-discretionary products, for example, donuts and a leading coffee brand. The strategic rationale for the acquisition remains strong, and we continue to be excited about the long-term outlook for the Hostess brand and its leadership position in the sweet baked goods category. The decisive actions we are taking reinforces our confidence in 4% net sales growth for the Hostess brand over the long term. We look forward to expanding on each of these pillars at our Investor Day in December and sharing further details about our strategy and the progress we are making across all our key growth platforms, including new marketing campaigns, exciting innovation, and future growth opportunities. Turning to the dynamics in each of our U.S. retail segments. In coffee, net sales increased 3% versus the prior year, driven by higher net price realization. In response to higher green coffee costs and the pass-through nature of the coffee category, we took our first price increase earlier this year in June across parts of our portfolio, which is now being reflected in our results. Price elasticity trends were favorable in the second quarter compared to our expectations and historical levels, demonstrated by the neutral impact from volume mix. In October, we successfully took a second price increase across our portfolio, as the coffee category continues to experience meaningful commodity volatility and inflation. We continue to anticipate historical elasticity demand assumptions, which are reflected in our outlook for the back half of the fiscal year. As always, we will manage our coffee business through a strategy that demonstrates a balance between recovering inflationary input costs while providing consumers with options across the value spectrum. In frozen handheld and spreads, comparable net sales grew 6%, primarily driven by the Uncrustables and Jif brands. Growth for the Uncrustables brand increased double digits versus the prior year. The Jif brand demonstrated net sales growth of 5%, reflecting a strong response to our recent launch of Jif peanut butter and chocolate flavored spread, which is exceeding our expectations. In pet foods, reported net sales decreased 4% versus the prior year, primarily due to a reduction in contract manufacturing sales related to the divested pet food brands. When excluding these contract manufacturing sales, net sales increased 1%, primarily driven by the Meow Mix and Milk-Bone brands. Overall, the dog snacks category continues to be impacted by a slowdown in discretionary spending, largely driven by inflationary pressures. We remain confident in our portfolio as we continue to leverage our core strengths to drive growth for the Milk-Bone brand with its strong leadership position in the category. We continue to see near-term challenges for the Pup-Peroni brand, and we are taking action to address this. Profit margins in the quarter were strong for our pet portfolio, driven by operational improvements from our transformation office and the winding down of our contract manufacturing agreement. Our transformed portfolio continues to highlight the benefits of focusing on brands and categories where we have a leading market position, as these brands continue to deliver net sales and margin growth. In our away-from-home business, comparable net sales grew 8%, driven by Uncrustable sandwiches and portion control products. Our away-from-home business continues to have a competitive advantage as it leverages our leading national brands and key growth platforms to deliver results and drive future growth in away-from-home channels. In closing, I would like to highlight a few key points. Our momentum continued into the second quarter, and our legacy business, which accounts for approximately 85% of our total company net sales, is delivering strong growth. This is a direct result of our portfolio optimization. We have confidence in the Hostess brand, and our strategic rationale for the acquisition remains strong. While the near-term performance has not met our expectations, we are taking decisive actions to return the brand to net sales growth. And our strategy is working, and we remain confident in our ability to deliver long-term sustainable growth and generate over $1 billion in free cash flow annually. As always, I would like to thank our dedicated employees for their exceptional contributions to provide the products and brands that consumers love. I'll now turn it over to Tucker to go over our quarterly financial results and our fiscal year 2025 outlook in more detail.
Thank you, Mark. Good morning, everyone. I'll begin by giving an overview of our second quarter results. Then I'll provide additional details on our financial outlook for fiscal year 2025. In the quarter, net sales increased 17%, which exceeded our expectations. Comparable net sales increased 2%, which excludes the current year sales for the Hostess Brands acquisition, prior year sales related to the divested businesses, and foreign currency exchange. When further excluding contract manufacturing sales related to the divested pet food brands, net sales increased 4% versus the prior year. The increase in comparable net sales reflects a 2 percentage point increase from volume mix, primarily driven by increases for the Uncrustables, Meow Mix, Cafe Bustelo, and Jif brands, partially offset by lower contract manufacturing sales related to the divested pet food brands and a decrease for the Dunkin' brand. Net sales growth includes a 1% headwind from lower contract manufacturing sales related to the divested pet food brands. Comparable net sales growth also reflects a 1 percentage point increase from net price realization, primarily driven by higher net pricing for the Folgers brand, partially offset by lower net pricing for the Meow Mix brand. Higher net price realization for the Folgers brand reflects the first price increase implemented in June of this fiscal year in response to higher green coffee costs and the pass-through nature of the coffee category. The lower net price realization for the Meow Mix brand reflects the restoration of trade support for this brand. Adjusted gross profit increased $129 million, or 17% compared to the prior year. The increase primarily reflects a favorable impact from the acquisition of Hostess Brands, favorable volume mix, and higher net price realization, partially offset by higher costs and the impact of divestitures. Adjusted operating income increased $105 million, or 27%, reflecting the increased adjusted gross profit and the lapping of a $39 million charge in the prior year related to the termination of a supplier agreement, partially offset by higher SD&A expenses. The increase in SD&A was primarily driven by the acquisition of Hostess Brands and pre-production expenses related to the recently opened Uncrustables sandwiches manufacturing facility, partially offset by the impact of divestitures. Below operating income, net interest expense increased $64 million, primarily due to an increase in interest expense related to the senior notes issued to partially finance the acquisition of Hostess Brands. The adjusted effective income tax rate was 24.1%, compared to 24.3% in the prior year. Factoring all these considerations, along with a weighted average shares outstanding of 106.7 million, second quarter adjusted earnings per share was $2.76, an increase of 7% versus the prior year. Adjusted earnings per share exceeded our expectations in the quarter, driven by better than anticipated adjusted gross margin and timing of SD&A expenses, primarily marketing. Turning to our segment results, in the U.S. Retail Coffee segment, net sales increased 3% versus the prior year. Net price realization increased net sales by 3 percentage points, primarily reflecting list price increase in mainstream roast and ground and instant coffee to recover higher commodity costs. Volume mix was neutral to net sales, reflecting a decline for the Dunkin' brand, mostly offset by double-digit increase for the Café Bustelo brand and an increase for the Folgers brand. Net sales growth was led by the Folgers and Café Bustelo brands, which grew 5% and 20% respectively, partially offset by an 8% decline for the Dunkin' brand. U.S. Retail Coffee segment profit increased 19%, primarily reflecting lapping the $39 million charge in the prior year related to the termination of a supplier agreement and higher net price realization, partially offset by higher commodity costs. In U.S. Retail Frozen Handheld and Spreads, net sales increased 5%. Excluding non-comparable sales in the prior year related to the divested Sahali Snacks business, net sales increased 6%. Volume mix increased net sales by 8 percentage points, primarily driven by increases for Uncrustables sandwiches and Jif peanut butter. Net price realization decreased net sales by 2 percentage points, primarily driven by higher trade spend for Uncrustables sandwiches, reflecting our investments in promotion and merchandising. U.S. Retail Frozen Handheld and Spread segment profit decreased by 10%, primarily driven by higher costs, lower net price realization, pre-production expenses related to the new Uncrustables sandwiches manufacturing facility, and increased marketing spend, partially offset by favorable volume mix. In U.S. Retail Pet Foods, reported net sales decreased 4% versus the prior year. Volume mix decreased net sales by 2 percentage points, primarily driven by a $23 million decrease in contract manufacturing sales related to the divested pet food brands and decreases for the Canine Carryouts and Pupperoni brands, partially offset by increases for the Meow Mix and Milk-Bone brands. Lower net price realization decreased net sales by 2 percentage points, primarily reflecting higher trade spend for cat food and dog snacks. U.S. Retail Pet Food segment profit increased 25%, primarily driven by lower costs, favorable volume mix, and lower distribution and marketing expenses, partially offset by lower net price realization. In the Sweet Baked Snacks segment, which reflects the acquired Hostess Brands business, net sales was $316 million and segment profit was $71 million. The segment delivered net sales and segment profit below our expectations. Lastly, in International Away From Home, net sales decreased 1%. Excluding non-comparable net sales in the prior year related to divestitures and unfavorable foreign currency exchange, net sales increased 6%. Net price realization contributed 4 percentage points to net sales, primarily driven by list price increases across the majority of the portfolio, partially offset by increased trade spend. Volume mix increased net sales by 2 percentage points, primarily driven by increases for peanut butter and portion control products and Uncrustable sandwiches, partially offset by a decrease for coffee products. Net sales for the away-from-home business increased 8% on a comparable basis, primarily driven by Uncrustable sandwiches and portion control products. Net sales for the international business increased 3% on a comparable basis, primarily reflecting favorable volume mix. International and away-from-home segment profit increased 13%, primarily reflecting higher net price realization and favorable volume mix, partially offset by higher costs, the impact of non-comparable segment profit in the prior year related to the divested businesses, and pre-production expenses related to the new Uncrustable sandwiches manufacturing facility. Second quarter cash flow provided by operating activities was $404 million compared to $177 million in the prior year, primarily reflecting higher net income adjusted for non-cash items, timing of income tax payments, and less cash required to fund working capital. Free cash flow was $317 million compared to $28 million in the prior year, driven by the increase in cash provided by operating activities and a decrease in capital expenditures. We finished the quarter with a cash and cash equivalent balance of $49 million and a total debt balance of $8.2 billion. Our trailing 12-month adjusted EBITDA is approximately $2 billion. When accounting for acquisitions and one-time transaction and integration costs, our pro forma adjusted EBITDA is approximately $2.1 billion, which equates to a leverage ratio of 3.9 times. We plan to prioritize debt reduction by paying down approximately $500 million of debt annually in each of the next 3 years before factoring any use of transaction proceeds from the Voortman divestiture. We plan to use the proceeds from the Voortman divestiture to pay down debt once the transaction is complete, which we anticipate will close during the third quarter of our fiscal year. With this anticipated deleveraging, achievement of cost synergies, and overall business growth, we anticipate a leverage ratio at or below 3 times net debt to EBITDA by the end of fiscal year 2027. This level of debt provides the financial flexibility for a balanced approach to capital deployment while maintaining an investment-grade debt rating and the flexibility to undertake strategic growth opportunities. Let me now provide an update on our outlook for fiscal year 2025, which does not reflect any impact related to the company's previously announced agreement to divest the Voortman business. We continue to expect full-year net sales to increase 8.5% to 9.5% compared to the prior year, reflecting a full year of sales from the Hostess Brands acquisition, a 1% unfavorable impact from reduced contract manufacturing sales related to the divested pet food brands, and a 1% headwind from lapping sales of the divested Canadian condiment and Sahali Snacks businesses. On a comparable basis, net sales are now anticipated to increase approximately 1.5% at the midpoint of our guidance range of 1% to 2%, including approximately $35 million of contract manufacturing sales related to the divested pet food brands versus $136 million in the prior year, or a 1% unfavorable impact. This guidance range reflects higher net price realization, primarily driven by the pricing actions recently implemented across our coffee portfolio in response to higher green coffee costs. Comparable net sales growth also reflects volume mix growth for the Uncrustables, Meow Mix, Cafe Bustelo, Milk-Bone, and the away-from-home business for the full fiscal year. The net sales guidance reflects the following changes from our previous assumptions. Better than anticipated second quarter results driven by each of our U.S. retail segments, partially offset by the Sweet Baked Snacks segment. Reduced expectations for our Sweet Baked Snacks segment of approximately $60 million versus our previous expectations, of which $30 million occurred in the second quarter. We now anticipate full-year net sales for the business to be approximately $1.3 billion. Increased expectations for the Uncrustables brand, including surpassing $900 million in net sales this fiscal year, or over $100 million of growth versus the prior year. The full-year net sales guidance does not reflect any impact related to the company's previously announced agreement to divest the Voortman business, which is expected to impact the current fiscal year by approximately $65 million. We now anticipate full-year adjusted gross profit margin in the range of 37.5% to 38%, reflecting favorable costs in our second quarter. We continue to expect SD&A expenses to increase by approximately 9% versus the prior year, primarily reflecting a full year of operating expenses from the Hostess acquisition. Total marketing expense is estimated to be slightly below 5.5% of net sales. We anticipate net interest expense of approximately $400 million and an adjusted effective income tax rate of 24.3%, along with a full-year weighted average share count of 106.7 million. Taking all these factors into consideration, we now anticipate full-year adjusted earnings per share to be in the range of $9.70 to $10.10, which reflects a 10-cent increase at the midpoint of the guidance range relative to our previous guidance. The full-year adjusted earnings per share guidance does not reflect any impact related to the company's previously announced agreement to divest the Voortman business, which is expected to be approximately 10 cents. We anticipate the earnings impact will be immaterial to the adjusted earnings per share guidance range when considering the use of proceeds to pay down debt. We anticipate third quarter net sales to be flat versus the prior year. Third quarter adjusted earnings per share is anticipated to decline mid-single digits, primarily driven by higher SD&A expenses versus the prior year. Higher SD&A expenses is driven primarily by marketing due to a shift in timing from the second quarter. We project free cash flow of approximately $875 million, with capital expenditures of $450 million for the year. Other key assumptions affecting cash flow include depreciation expense of approximately $300 million, amortization expense of approximately $225 million, share-based compensation expense of $35 million, and other non-cash charges of $90 million. In closing, we delivered positive results in a dynamic consumer environment and remain in a strong financial position to deliver sustainable and consistent long-term growth for our shareholders. And I would like to express my appreciation for our employees. They have demonstrated their commitment to executing with excellence, and their passion for our company positions us for continued success. Thank you.
Good morning, and welcome to the J.M. Smucker Company's fiscal 2025 second quarter earnings question and answer session. This conference call is being recorded, and all participants are in listen-only mode. Please limit yourselves to 2 questions and re-queue if you have additional questions. I'll now turn the call over to Crystal Beiting, Vice President, Investor Relations and Financial Planning and Analysis. Thank you. You may begin.
Good morning, and thank you for joining our fiscal 2025 second quarter earnings question and answer session. I hope everyone had a chance to review our results as detailed in this morning's press release and management's prepared remarks, which are available on our corporate website at jmsmucker.com. We will also post an audio replay of this call at the conclusion of this morning's Q&A session. During today's call, we may make forward-looking statements that reflect our current expectations about future plans and performance. These statements rely on assumptions and estimates, and actual results may differ materially due to risks and uncertainties. Additionally, we use non-GAAP results to evaluate performance internally. I encourage you to read the full disclosure concerning forward-looking statements and details on our non-GAAP measures in this morning's press release. Participating on this call are Mark Smucker, Chair of the Board, President and Chief Executive Officer, and Tucker Marshall, Chief Financial Officer. We will now open the call for questions. Operator, please queue up the first question.
Thank you. The question and answer session will begin at this time. If you're using a speakerphone, please pick up the handset before pressing any numbers. Should you have a question, please press star 1 on your telephone. If you wish to withdraw your question, please press star 2. For operator assistance, please press star 0. As a reminder, please limit yourselves to 2 questions during the Q&A session. Should you have additional questions, you may re-queue, and the company will take questions as time allows. Please stand by for the first question. Our first question is coming from Andrew Lazar from Barclays. Your line is now live.
Great. Thanks so much for the question. Good morning. Mark, you now expect flat year-over-year sales in your fiscal third quarter, even though the top-line momentum has been solid thus far this year and certainly well above that. And the timing of the SD&A spend moving, I guess, to the third quarter, I would think would only help the top line. So is there something discrete you see impacting third quarter sales? Maybe it's just Hostess moving into the base, or what's driving sort of that expected deceleration?
Yeah, Andrew, good morning. This is Tucker.
Hey, Tucker.
Thanks for the acknowledgement on delivering a strong second quarter, and we do see the momentum continuing through the back half of our fiscal year. Specifically to your question around flat year-over-year top line for our third quarter, really what we're assessing is the second round of pricing within our coffee portfolio. So we're anticipating flat coffee sales. We're also seeing the pet portfolio lapping a very strong comp in the prior year, along with assessing the discretionary nature of overall pet treating and also reduced co-manufacturing sales. Further, we have called down sweet baked snacks that we acknowledged in our prepared remarks, and then we're seeing that being offset by growth in our frozen handheld and spreads portfolio, which is really the focus of the outlook for Q3.
Great. No, that's really helpful. Thank you for that. And then, best we can tell, your new Hostess sales guidance for the full year implies, I think, a low single-digit year-over-year decline in the second half. I guess first, do I have that right? And if so, obviously it's more realistic, but still implies a sequential improvement from the, call it, mid to high single-digit declines we've seen for the brand more recently. So I guess what's expected to drive that sequential improvement in the second half, and sort of what's your visibility to that sort of outcome? Again, if I have the calculation right for the back half. Thanks so much.
Andrew, you are correct. The sales guidance for FY25 implies a low single-digit year-over-year decline in our second half. We are seeing some sequential improvement as we move through the fiscal year. That's really due to 2 reasons. One are the outlined remarks around what we're doing to improve execution across the portfolio that came through Mark's section. And then secondly is just lapping some easier year-over-year comparables.
Right. Thank you so much. Appreciate it. See you in December.
Thank you. Next question is coming from Ken Goldman from J.P. Morgan. Your line is now live.
Hi, good morning, and thank you. I'm just wondering, to continue the conversation on Hostess, can you update us a little bit on what you're thinking in terms of synergies both this year and next, in light of maybe a little bit of a longer path to kind of get back to that 4% top-line growth longer term?
And this is Tucker. I'm going to frame in the cost synergies and then have Mark talk a bit about how we're thinking the revenue synergy component. But on the cost synergy front, we're still committed to $100 million of achievement by the end of our fiscal year 26. We're seeing that balanced about half in this fiscal year and half in next fiscal year. And we should be able to achieve that $100 million outlook even after completing the Voortman divestiture.
Ken, it's Mark. Just maybe to play back a little bit of my prepared remarks. So we still feel really excited about Hostess. We love the brand. We think there's a lot of opportunity for it, and just wanted to acknowledge in the prepared remarks that there were just 2 things that were driving the underperformance. One was just the continued cautiousness of the consumer, right, in terms of inflation and lower discretionary income, and then a bit of execution on our part, which was not related to the integration, because the integration went well, it's behind us, and it's complete. But what we really have started to pivot to do is making sure that we're doing four key things: is execute it better against base fundamentals, which is getting more display because it is an impulse category, expanding distribution at shelf, and notably in the away from home channel. We are going to be launching a fantastic new marketing and advertising campaign in the new year, which we believe will be very relevant to consumers and really speak to the emotional connection to the brand. And then that would include a packaging refresh, some innovation. We will be looking at launching like $1 packs, so we will bringing different value equations to the consumer. And then lastly, we've had some early tests on co-promoting Hostess with some of our legacy brands, think coffee, and less discretionary brands. And early reads on those co-promotions are very strong. So accelerating those efforts is another thing that we'll be doing. So over the coming quarters, we would expect to see improvement in the Hostess results and just remain confident in that brand because of overall snacking trends continue to remain positive across multiple categories.
Great, thank you for that. And then just quickly, a pivot to the broader company. How would you like us to think about the balance between price versus volume mix for the rest of the year? With the understanding there's a lot of puts and takes in there. Just a general sense would be helpful.
Yeah, as we think about the full year, Ken, I think it's easier to kind of break it down this way. If you think about our outlook at the midpoint of our guidance range, it's 9%. When you isolate the impacts of acquisition, divestiture, foreign exchange, comparable growth is probably around 1.5. When you think of the pet co-manufacturing, that gives you about another point. So base business is about 2.5 to 3, and within that, you're probably equally split between volume mix and price on a full year basis.
Perfect. Thanks so much.
Thank you. Next question is coming from Robert Moskow from TD Cowen. Your line is now live.
Hi, thanks. I had a couple of questions about Hostess. One is, Mark, you mentioned that execution weakened. Can you give us a little more details on what aspect of that weakened and what caused it and how you can fix it? And then secondly, a broader question. I appreciate the plans to market Hostess more aggressively in first quarter 25, but are there any concerns internally about whether it might get drowned out? There's a lot of messaging from the new administration on Make America Healthy Again. I'm just wondering, is this the right time to be aggressively marketing indulgent snacks, and how do you think the consumer will receive it?
Sure, Rob, it's Mark. First of all, just on the category in general, remember that when I talked about this less discretionary income and inflation, that has affected all channels. So that is, it's traditional channels, it's convenience. We've seen the entire convenience channel be down a bit, and so that has clearly impacted. And then, I guess what I would highlight is we would have liked to have seen our execution drive a bit more display. And so when I mentioned that, we are going to really be ramping up our efforts across channels to make sure that our display is in place, is relevant, that we're supporting that with, innovation. And again, we do think there's some opportunity with these co-promoted events that will take place in the future and continually off and on throughout the next, obviously, several quarters. As it relates to anything in the political domain, we believe very strongly that snacking continues. The trends are supportive. Consumers continue to eat a couple snacks a day. That continues to be the case. And indulgent snacking, whether it's Hostess or snacking more like Uncrustables that contains protein, those will continue, and consumers are going to continue to look for a way to reward themselves at different times throughout the day. So continuing to connect the dots between the brands and the consumers and what they're seeking, whether that be portion size or, less indulgent, more indulgent, we have an obligation to continue to grow the brand, and that's what we're going to continue to focus on.
Great. Thank you.
Thank you. Next question is coming from Peter Galbo from Bank of America. Your line is now live.
Hey, guys. Good morning. Thanks for taking the question.
Morning.
Tucker, maybe just to start, if we look at the EPS guidance going back to kind of the start of the year, your midpoint has now moved, I think, from $10 to $9.80, now back to $9.90. And I just want to understand, like, the volatility in what you've seen, from a cut and then a raise. Maybe you can just unpack that a bit more for us, because it was a bit odd to me. I don't know if the visibility is maybe lower than it would have been historically, but just any help in unpacking kind of why the shift has been as much as it has. Thanks.
Yeah, so you are correct. We came into the year with a midpoint at guidance of $10, and we revised down to $9.80 coming out of the first quarter at the midpoint. Really, that change was largely driven by a reduction in our top-line outlook, and also driven by ongoing green coffee inflation and the need to take a second round of pricing. As we took up our outlook for this quarter, up 10 cents, so now at the midpoint of our guidance range, $9.90, really what we're doing is we're locking in the component of the gross margin beat in our second quarter. And so that, in our mind, is a good story in acknowledging our ability to bring up our outlook at the bottom line for the full year.
Got it. Okay, that's helpful. And maybe while we're on the subject of coffee, Mark, coffee prices seem to kind of make new highs every day, at least in the commodity markets. You've taken 2 rounds of pricing at this point. Just how you're thinking about potential, the need to take additional pricing, and maybe the elasticity impact that could have as well. Thanks very much.
Sure, Peter. Mark here. So coffee, as we all know, it's a pass-through category. We've been very pleased with our performance in the quarter, despite the fact that we continue to see significant inflation. I would highlight that, Arabica hit $3 yesterday, and we haven't seen $3 Arabica for probably over 10 years, and so it is unusual. I would highlight that the market for coffee today is very speculative because we haven't hit harvest season yet. And so a lot of the volatility we're seeing is really related to financial speculation. As we get into the harvest, we will have more intel in terms of what that looks like. We would hope that we would get a bit of relief, assuming we have a good crop. There are some indicators that we might, but it's still a bit early to start to anticipate what could be. But at the end of the day, we have to be responsible. We want to make sure that we are able to pass along cost changes both up and down, and we do intend to do that. And we will continue to pull the levers available to us, whether that's trade or obviously cost reduction, to try to make sure that we don't take price up too much, and very careful to what the consumers can bear. But we will be responsible, and we will continue to manage the coffee business the way we always have.
Thank you. Next question is coming from Chris Carey from Wells Fargo. Your line is now live.
Hi. Good morning, everyone. I wanted to follow up on Pete's line of questioning around coffee, but maybe moving it even a little bit forward. Mark and Tucker, you've made some comments about fiscal 26 EPS being above algorithm. And as we assess Hostess trends, clearly an expectation for it to get better against easier comps, specifically perhaps into next summer at C stores. but you also have this coffee inflation dynamic as well that it sounds like you would want to price against that going into next fiscal year. How does this all, I guess, come together in the context of, earnings aspirations that you have beyond this fiscal year?
Chris, good morning. It's probably early to talk about the outlook for fiscal year 26, but I can certainly appreciate the question. I think what I'd like to frame in is sort of the components that we're considering against that outlook for 26. First of all, what is base business momentum? And you've sort of alluded to some of that in your questions. Two is the removal and mitigation of stranded overhead associated with the pet food divestiture. Three is the realization of synergies from the Hostess acquisition. Also, as we think about ongoing advancements from our cost and productivity programs associated with our transformation office, and then thinking about the benefits from debt paydown, particularly a reduced interest expense. And that's really the framework that we're considering for next year. We'll continue to have a better assessment as we complete this fiscal year and we continue to plan for next year. But it's too early to call the outlook for next year.
Okay, fair. One follow-up. We've received more questions around coffee consumption in recent weeks, some theorizing that weather may be some driver of some sequential softness in volumes for the entire category. What is your assessment of sequential developments in the coffee category and also for your business, and how you see the impact of elasticity, perhaps weather, and any other considerations that we should be thinking about, going forward from here? Thank you.
Chris, that's a tough one to answer, to be totally honest. What we continue to see is that, our business is an at-home business for the most part. We do have a nice away-from-home piece of the business, but the majority of our coffee business is at home. The data continues to support 70% of cups consumed are still consumed at home. And, we do see, positive, usually a bit more consumption around the holidays. Obviously, that can be related to family gatherings as well. But in general, we still feel very positive around our coffee business in total. The consumer, as they do shift to different forms, whether that's liquid, in the past it's been one cup. We have demonstrated our ability to shift our portfolio to where the growth is, and that's where we're going to continue to focus.
Okay, thank you.
Thank you. Next question today is coming from Tom Palmer from Citi. Your line is now live.
Good morning. Thanks for the question. I wanted to maybe just start off on sweet baked snacks. You noted some of the planned changes here as we roll into the new year: packaging, displays, marketing. Where are we in kind of the selling cycle to customers? How have these changes been received? Do you have visibility at this point into improved distribution or merchandising from rolling these changes out?
Yeah, we've already are actively engaged with several of our key customers, and those discussions have been positive. I think at the end of the day, being a leader in this category, where we can demonstrate winning, they win too. And so it really needs to be a win-win. The way we work with our customers, regardless of which channel that is, bringing to bear insights, data, and ultimately thinking holistically about the categories allows us to bring partnership to our customers that they like and they need, and everyone wins. So the goal is to grow not only the Hostess business, but to grow the category as well.
Okay, thanks for that. And then I appreciate maybe you don't want to comment in full on 26, but you did bring up some of the puts and takes, and I wanted to ask on the stranded costs in the pet segment. As we think about some of the TSA unwind here, I think it's occurring quite soon. and the ability to address stranded costs, are there benefits this year or headwinds this year to consider? And then just to confirm, the number for next year is still 60 cents year over year?
Yeah, Tom. So we have completed the transition services agreement with Post Holdings. That was completed in our second quarter. We have called out in this fiscal year a net 60-cent impact of stranded overhead. That is confirmed as an impact to this fiscal year. As we move forward into next fiscal year, we have acknowledged that we are working to mitigate or otherwise remove those stranded overhead, so it should not be a drag to earnings as we think about our growth year over year.
But it should be a tailwind, right?
Correct.
Okay. Thank you.
Thank you. Next question today is coming from Alexia Howard from Bernstein. Your line is now live.
Good morning, everyone.
Morning.
So can I just ask a sort of, not just about Hostess, but a broad question on the GLP-1 weight loss drugs, more specifically around how are you tackling the question of gathering information about what the consumer needs there? You've obviously got some parts of the portfolio that play well into that segment, things like Jif peanut butter. Obviously, the pet food and the coffee is pretty benign. And then we have Hostess, which could be pressured. It seems as though there might be as many as mid-single-digit percentages of U.S. adults on these drugs now, and it's obviously likely to escalate. I think there were articles out this morning about the potential for Medicare and Medicaid to cover them. How are you tackling the question of getting information about what innovation, what you need to do to tackle that trend, and how urgently, what resources are you putting against that relative to other developments in the market?
Alexia, it's Mark. So first of all, thank you for acknowledging the breadth of our portfolio, because obviously being in pet, coffee, spreads, and other forms of snacking bodes very well, because we play in a lot of different categories that win in different ways. So appreciate the acknowledgement. And then, as I've said in prior quarters, we look very closely at all of the trends and really are focused on what the consumer is saying and wanting. And specifically, we continue to do an ongoing research on the impact of GLP-1 trends and what that might mean for our business. And the facts are that at this point we have seen no material impact to any of our business as a result of that trend. Acknowledging that snacking would be a logical place where we might see an impact. To date, we have not seen anything meaningful. That said, we're going to continue to monitor it, as we always do, and we're going to continue to look for innovation that is relevant for consumers that might be looking to change their diet. I mean, keep in mind, been in business for 127 years. We've been through every different type of diet trends across the consumer landscape, and have effectively provided products that meet the needs, whether that's portion size. We could look at reducing sugar. There's a whole variety of innovations that we will bring to bear. And so really thinking of it as an opportunity is what we have to continue to do, all the while monitoring what the impact may be.
Thank you very much. And just a real quick follow-up. On Voortman's, the divestment, you've said that you expect a 10-cent hit to earnings this year. Is that based on the expectation that it will close at the end of the third quarter or somewhere in the middle of the third quarter? I'm just trying to get a sense for how much the impact could be going out into next year.
Yeah, Alexia, so on a full-year basis, the Voortman impact is 25 cents. We announced that in the press release around the transaction. The impact to this fiscal year, because we're closing a little bit more than halfway through the year, so it'll be probably the middle of our third quarter, is 10 cents. But we anticipate using $300 million in proceeds from the transaction to pay down debt, which would partially offset that 10 cents, leaving about a nickel, therefore kind of immaterial to our overall guidance range or outlook for the year.
Perfect. Thank you very much. I'll pass it on.
Thank you. Next question is coming from Matt Smith from Stifel. Your line is now live.
Hi, good morning, Mark. Thank you for the question. One of the drivers for the increased comparable sales is the momentum in Uncrustables. Growth has been stronger than anticipated. You mentioned new products in your remarks and the increase in capacity, but as we look forward, can you talk about the drivers of growth in the second half and beyond? Are you seeing stronger distribution opportunities, or is this more velocity driven as you increase your investment? Thank you.
Matt, I can't believe we've made it this long into the call without an Uncrustables question, so thank you. Uncrustables is doing fantastic. As you saw, we did the ribbon cutting. I was in Alabama earlier in the month with the governor, opening the third site, which is up and running, continuing to expand production there over the next several months. But the fact that we're now in demand-generating mode allows us to advertise, allows us to clearly meet the demand that the consumer is giving us, and launch new products. So the raspberry Uncrustable, the peanut butter and raspberry, is far exceeding our expectations. It's a fantastic product. We also launched a limited peanut butter only SKU, which will go national next year, and really pleased with the performance of the brand, and actually overall it's exceeding our expectations. So we do expect to hit $900 million this year, which is ahead of our expectations. I think it's safe to say we're going to meet or exceed the $1 billion in 26, like we said, and so we have not put any markers out there for beyond $1 billion, but we do believe we're going to get beyond $1 billion with the support of great production, great teams in all three plants, and frankly, the ability to continue to bring out new products and new varieties. So really bullish on the Uncrustables business.
Thank you. Next question today is coming from Rob Dickerson from Jefferies. Your line is now live.
Great. Thanks so much. I just had a couple questions kind of on the profitability side. Mark, maybe Tucker, I know historically there have been times when you've been willing to provide a little bit of incremental color on a per segment basis, just kind of around maybe where op margin could kind of fall for the full year. So kind of first, I'm just asking specifically on coffee, right? I mean, coffee, all things considered, done pretty well in the first half of the year. I'm assuming, just given the pass-through nature, that comes down in the back of the year. So, I guess first question is just kind of how do you, as of today, like kind of view that op margin for the year playing out?
Yeah, Rob. So I would start big picture and just acknowledge at the total company level, we delivered a strong gross margin in the second quarter, better than our expectations. We're able to lock in that over delivery into our EPS guidance range, and also align to a 37.5% to 38% gross profit margin outlook for the full year. And really, the portfolio is coming in line with margin expectations at the segment level. In some instances, some businesses are a little bit better, some businesses are around sort of their expectation. But where you are seeing that margin change is in the coffee portfolio, which we acknowledge coming into this fiscal year, and we also acknowledge coming out of our first quarter. And that's really driven by 2 rounds of pricing actions to recover ongoing green coffee inflation. And so coffee margins in the first 2 quarters were very, very good. Candidly, they were in the 28% level for both Q1 and Q2. But as we get into the third and fourth quarters, you will see that come down substantially to kind of the mid-20s and low 20s as a result of that ongoing green coffee inflation as we get into the higher costed component of our cost structure.
Okay, that's very helpful. And then maybe just to touch on a kind of comment you just made, which is going to be a question anyway. It seems like they're clearly they're moving pieces around the segments in terms of how profitability is coming in, right? I think you said originally pet might have been kind of 25% or so op margin in Q2, might come in a little bit better, right? So far in the first half, pet's coming in at 28% op margin, and that's without the release of all the stranded overhead. So I'm just curious, like if we're thinking about kind of that total portfolio, let's say in the back half, right, coffee margin comes down a little bit, totally understood as to why. Seems like kind of frozen handhelds and spreads is kind of maybe running around that 23-24% range. Pet's doing a lot better, right? And then sweet baked snacks, I'm hearing a little pull forward and some activation. Maybe there's a little bit more investment coming in the back half. So is it fair to say, just kind of all in, that coffee margin's coming down some, pet probably higher than we originally thought, frozen's kind of in line-ish, and maybe sweet baked snacks comes a little lower kind of in Q4. So net, it all kind of plays okay, but really pet is driving kind of some of the offset and funding of some of the other parts of the business. There's a lot in there, but that's all I have. Thank you.
Rob, you are right. There is a lot in there. But I do want to acknowledge, I understand your framework. I think we have a scheduled follow-up call, so why don't we go through the puts and calls of your model then? But I certainly understand the framework. Thanks.
Okay, great. Thanks a lot.
Thank you. Next question is coming from Steve Powers from Deutsche Bank. Your line is now live.
Hey, thanks. Just a quick, I guess, follow-up to some extent on the pet business. Tucker, you called out, as you talked about the three key puts and takes, it's just some, I guess, caution or conservatism, acknowledgement of the discretionary nature of pet treating. I would love an update on what you're seeing, in that category. It appears to us, I guess, at least sequentially, that the kind of the sensitivity to demand has held pretty stable. We were looking for things to potentially get worse quarter over quarter, and that doesn't seem to have happened thus far this year. So I'm just curious what you're seeing, and are you expecting relative sequential stability, or do your comments kind of portend another step down in demand as you go into the back half?
Hey, Steve, it's Mark. I'll take that one. Milk-Bone continues to perform, and it's essentially for two reasons. One is we play across the whole value spectrum. So we've got Milk-Bone has products that compete in value to premium in all of the different treating occasions, whether that's dental or long-lasting chews or just basic biscuits, core biscuits. So I'd say the breadth of that brand continues to perform. And then secondly, our innovation is working. Regardless of where we've innovated, it seems to have brought new news, it's driving sales. Notably, the innovation that's been really winning for us are the peanut buttery bites, which actually contain Jif, and those have been performing exceptionally well. So Milk-Bone, although growth has been a little bit subdued because of the discretionary nature of the category, continues to perform. And even in our soft and chewy segment with Pop, where we are down, we now are bringing to bear new plans in terms of refreshing the brand, leveraging the fact that brand has an extremely high consumer loyalty. And so really thinking about how we're going to go to market, really emphasize the product quality of that product. So we're going to support the whole breadth of our snacking portfolio, not just Milk-Bone.
Okay, fair. So just playing that back, it sounds like any slowdown in your pet business in the third quarter is more about just the underlying comp being more difficult than anything getting more difficult in the actual category demand backdrop. Is that fair?
Yeah, we're not co-manufacturing for Host anymore, and so the comps will not look great, but we would keep you guys focused on the existing business and the comps apples to apples versus the prior year. So we'll make sure we clarify that with you.
And
Steve,
we're not calling down any incremental softness to the Milk-Bone brand. We're just acknowledging that it's growing at a slower rate as a result of the overall discretionary nature of the category, and that's kind of embedded in there. So my comments as it relates to Q3 were more around the comparable. 2 is just where the treating aspect of the category stands, and then 3 is just the mechanical math of co-manufacturing sales.
Yeah. Okay, we're aligned. Understood on all of that. Thanks so much.
Thank you, Steve.
Thank you. Next question today is coming from Max Comfort from BNP Paribas. Your line is now live.
Hey, thanks for the question. Going back to coffee, I think earlier on this call you mentioned an expectation for flat net sales growth in the second half. You just did a 3% sales growth for coffee in the second quarter, and I realize you're embedding elasticity assumptions in the second half, but to me that sounds pretty drastic if I heard it right, that you go from a +3 to something that's more like flat in the second half as you bring on pricing for what's historically been a pretty inelastic category. So just wanted to clarify on your expectations for the coffee top line in the second half. Thanks.
Yeah, Max, my comments related to coffee being flat were in our third quarter. We will see a level of growth in our fourth quarter. And as you know, we've taken 2 rounds of pricing, and the second round of pricing was essentially in mid-October. So we'll begin to see the effects of the second round against price elasticity of demand in our early winter. And so that's what we also continue to monitor and assess. The good news is that our portfolio continues to perform with the strength of our leadership in the category.
Okay, got it. That's helpful. And then on pet food, the prepared remarks had comments about a price cut for Meow Mix and then higher trade spend in cat food and dog snacks. So putting the consumer caution aside, can you just talk about what you're seeing in the competitive environment that's informing those types of decisions? And I'll leave it there. Thanks very much.
Yeah, Max, the Meow Mix brand continues to be a bright spot and a highlight of the overall pet portfolio and within the company. And we were able to restore some of the promotional activity against the brand, particularly as we became full supply and back in stock against the brand. And we continue to drive innovation across the portfolio as well.
Thank you. We've reached the end of our question and answer session. I'd like to turn the floor back over for any further closing comments.
Kevin, thank you. Well, first, I'd just like to thank everyone for taking the time today on a holiday week to join our call. We had another great quarter, and that would not have been possible without our outstanding employees. So as always, I'd like to thank them for their continued hard work and dedication to our company. We're really looking forward to hosting our Investor Day on Tuesday, December 10th in New York City. And so for any additional requests, please reach out to Crystal Biting. And just hope everyone has a very happy Thanksgiving and a great holiday week, and hopefully get some rest over the weekend. So thanks again.
Thank you. That does conclude today's teleconference and webcast. You may disconnect your line at this time and have a wonderful day. We thank you for your participation today.